All right, let's get right into it. There's a story playing out in the housing market that the big headlines are completely missing. It's not about some huge, dramatic price collapse, at least not yet. No, this is something quieter, something a little more subtle, and honestly, a lot more important. We're going to pull back the curtain on what's really going on with this shadow real estate crash.
You know, this quote right here, it just perfectly captures the strange situation we're in. I mean, imagine a market where things don't suddenly plummet. They just freeze. The music just stops, and everybody's left standing around, totally unable to move. That's the real mystery we're digging into today. What on earth happens when a market just grinds to a halt and all the liquidity vanishes?
So on the surface, right, if you just glance at the news, you'd think everything's fine. National home prices, they look totally stable, maybe even up 0.5%. But that price tag, it's an illusion. The reality is that the number of actual houses being sold has completely fallen off a cliff. We're talking back to the kind of lows we saw in the middle of the pandemic. And here's the thing, a price is only real if someone is actually willing and able to pay it.
So our investigation really starts with this vanishing act. How does a market this huge just stop? Well, the answer isn't in one single data point. It's in a whole series of clues. And the first big clue is this really strange, historic split in how people are acting with their money. Experts are calling it a consumer divergence.
Okay, this is where things get really interesting. Because what's happening isn't your typical recession behavior, where everyone just tightens their belts across the board. Nope. We're seeing this massive split, this consumer divergence. It's like a tale of two different economies, where people are still spending like crazy on some things, while slamming on the brakes for the biggest purchase of their entire lives.
And this chart just visualizes that gap perfectly. I mean, just look at the difference here. On one side, you've got really strong consumer spending. People are still doing renovations, they're still buying stuff. But on the other side, the housing market is in a freefall. Mortgage applications crashed by a staggering 28.5% in just 3 weeks. It sends a pretty clear signal, right? People are confident enough to buy tools and tacos, but they are absolutely terrified to buy a house.
Now, this split isn't happening by accident. It's being driven by four incredibly powerful forces. First up, you've got the locked-in effect. I mean, millions of homeowners are sitting on these golden ticket 3% mortgages. They have zero incentive to sell that and buy a new home at 7%. Then there's the K-shaped economy. Affluent households are doing just fine, but lower-income families, they're getting crushed, and you can see it in soaring credit card delinquencies. Third, we've got cost fatigue. People they're worn out by high prices and they're cutting back. And finally, the big one, the affordability gap is now a chasm. Housing costs are demanding over 40% of the median household income. It's just not sustainable.
So all those forces we just talked about have created this really fundamental imbalance in the market. This is our second major clue. And to understand just how dangerous this is, we have to talk about the absolute lifeblood of any market, liquidity.
So here's the crucial point. A healthy market, it doesn't matter if it's for stocks or for houses, it needs liquidity. It needs a big, wide-open door that lets sellers get out easily when they need to. The second that door starts to shrink, you get problems. Big problems.
And this slide, it just illustrates that problem perfectly. Just look at the rising bar on the left. That's the for sale inventory, and it's up 15% from last year. More and more sellers are rushing for that exit door. But at the exact same time, look at the shrinking bar on the right. The number of active buyers is at a multi-year low. So the line to get out the door is getting longer, just as the door itself is getting smaller.
This creates a really dangerous situation. You've got what people call shadow inventory. These are all the frustrated sellers who put their house on the market, got no serious bites, and then pulled the listing. But they're still there, waiting in the wings. So this growing pile of supply is meeting shadow demand, which is just a fancy way of saying there are very, very few real buyers out there. This is the classic setup for a buyer's market, where sellers completely lose their pricing power.
All right, this brings us to the most critical part of this whole thing, the smoking gun. We've established that the headline prices can be an illusion and that the market is pretty much frozen solid. So there has to be one metric, one key piece of data that cuts through all that noise and shows us the brutal truth of what's really happening.
I mean, think about it. Price is the last thing to move. It's a lagging indicator. It tells you what has already happened, not what is happening right now. So if those flat prices are giving us a false sense of security, what's the real leading indicator we should be obsessing over?
The answer is days on market, or DOM. This is the ticking clock. It measures exactly how long a property is sitting there for sale, and it tells a story of pressure and desperation that prices alone just can't capture.
The higher the DOM goes, the more financial pressure is building up behind the scenes.
And here is where that ticking clock really starts to hurt. This data shows you the real-world financial cost of waiting. If a seller can get a deal done in under 30 days, great. They get pretty much their full asking price. But if that same house just sits there, lingering on the market for 120 days, the seller is forced to slash the price by an average of 8.5% just to find a buyer. Every single day a house sits unsold, the seller's financial leverage is just evaporating.
And here it is, the brutal truth in one single number. A staggering 42%. 42% of all active listings in the country have already cut their price. That is one of the highest readings we have seen in over a decade. It is a massive signal that the pressure from rising days on market has reached a boiling point. Sellers aren't just waiting anymore. They're starting to panic.
Okay, so let's put all the pieces together. We have clue number 1, a frozen market. We have clue number 2, a massive gap between buyers and sellers. And we have our smoking gun, that ticking clock of days on market that's forcing huge price cuts. All this evidence forces us to redefine what a crash actually looks like in today's economy.
See, this isn't the loud, dramatic, explosive crash of 2008 that everybody remembers. That was a price crash. This is a liquidity crash. It's more like a silent seizure, where the ability to transact, to turn your house back into cash, just disappears. It's the terrifying inability to sell at any reasonable price, or maybe any price at all.
And this forces us to challenge one of the most deeply held beliefs in our culture, the idea that your house is an asset. I mean, if you go by the classic definition from Robert Kiyosaki, an asset puts money in your pocket. A liability takes money out of your pocket. Well, with a mortgage, taxes, insurance, and all the upkeep, your primary home is constantly taking money out of your pocket. And this is the point where the shadow crash becomes a personal financial crisis. When a liability also becomes illiquid, meaning you can't sell it, it transforms into a financial trap. You are forced to keep pouring money into this thing month after month with no way to stop the bleeding. It is a financial drain with a locked exit door.
And that leaves us with one final and pretty provocative question. We have rising inventory. We have that shadow inventory just waiting in the wings. And we have an exit door, liquidity, that is shrinking by the day. So what happens when a new catalyst, maybe a little dip in the economy or a rise in unemployment, forces all of those people to rush for that tiny door at the exact same time? Just think about that.